What does it mean when the price touches the upper Bollinger Band in a range-bound market? It confirms a strong breakout is starting. It means the price will stay flat. It suggests that volatility is decreasing. It may signal overbought conditions and a possible pullback. What is the best tactic when the price touches the lower Bollinger Band and RSI is below 30? Sell to exit before a breakdown. Enter a short position immediately. Look for a potential buy signal, confirming with other indicators. Avoid trading until the RSI reaches 70. Amazing. 2. What does a Bollinger Band squeeze indicate? That RSI is overbought. That the price will reverse sharply. A buildup of pressure that often leads to a breakout. An immediate trend continuation. Three. In a squeeze scenario, what makes a breakout more reliable? A volume surge accompanying the breakout. A contraction of RSI. Flat movement along the middle band. A histogram crossover. Four. What combination suggests a strong bearish breakout? RSI above 70, squeeze near resistance, and breakout with volume. Middle band breakout with no volume. Histogram shrinking and RSI at 50. Price bouncing at support. RSI below 30. Five in a row. When price rides the upper band in a strong uptrend, what tactic is recommended? Trade only if RSI drops below 30. Buy on pullbacks to the middle or lower band. Sell immediately when the price touches the upper band. Wait for a complete squeeze. What does a range-bound Bollinger Band setup suggest to a trader? Avoid all trades until RSI reaches 50. Trade in the direction of the last breakout. Buy near the lower band. Sell near the upper band. Always wait for the MACD to cross. What's a smart move when Bollinger Bands contract and the price nears a key resistance level? Watch for a potential breakout to the upside, but wait for confirmation. Ignore Bollinger Bands in resistance zones. Immediately enter a short position. Sell before volume rises. What should a trader do to manage risk during breakout trading with Bollinger Bands? Only rely on Bollinger Bands without confirmation. Enter with full capital during the squeeze. Ignore volume confirmation. Use stop loss orders just outside the breakout level. Two. What role does the middle Bollinger Band play in both uptrends and downtrends? It replaces the need for volume analysis. It often acts as a support in uptrends and resistance in downtrends. It signals trend exhaustion. It triggers entry without confirmation. It's time to discover Fibonacci levels. In this lesson, you'll explore the most important Fibonacci retracement levels used by traders. You'll learn how these levels help identify potential reversal zones, gauge correction depth, and build more strategic entry and exit plans. Let's start. Fibonacci retracement helps traders find potential pullback zones, places where the price might pause or reverse before continuing its trend. Traders identify a significant price movement, either upward or downward, and apply the Fibonacci retracement tool from the start to the end of that move. The tool then plots horizontal lines at key Fibonacci levels: 23.6%, 38.2%, 50%, 61.8%, 100%. You might be wondering, why 38.2%, 61.8%, or 78.6%? These percentages aren't random. They're based on a special number sequence found in nature, art, and even human behavior. Fibonacci levels come from a number sequence where each number is the sum of the two before it: 0, 1, 1, 2, 3, 5, 8, 13, 21, 34. When you divide one number by the next, or by others in the sequence, you get ratios like minus 61.8%, for example, 21% 34, minus 38.2%, for example, 21% 55, minus 23.6%, for example, 13% 55. Traders often treat Fibonacci levels as key decision zones during a pullback. When price reaches the 38.2 level, it's seen as a shallow retracement. This suggests strong momentum, and traders may look for early opportunities to rejoin the trend. The 50% level, although not a Fibonacci ratio, is widely recognized as a common pivot point. At this level, traders typically wait for confirmation before entering or adding to a trade. The 61.8% level, known as the golden ratio, is one of the most closely watched. It's often seen as a strong potential reversal area, where traders may place entries, stop losses, or take profits depending on their strategy. Right order. Fibonacci retracement in action. Every great Fibonacci setup starts with a process. Can you arrange the steps in the right order to find key levels and plan your next move? 1. Identify the trend. Drag here. 2. Find high and low. Drag here. 3. Drag here. Draw Fibonacci retracement. 4. Drag here. Watch price at key levels. Stock? Fibonacci levels show where price might pause, bounce, or reverse. In an uptrend, traders look to buy when the price pulls back to levels like 38.2%, shallow retracement, or 50%, moderate retracement. In a downtrend, traders may sell if the price retraces to 61.8%, deep retracement, or 78.6%, very deep retracement. In both uptrend and downtrend, Fibonacci helps them plan smart entry points, place stop losses, and choose profit targets. Fibonacci is a great guide, but traders rarely rely on it alone. Stronger setups form when Fibonacci levels align with key moving averages, horizontal support resistance, and candlestick or volume confirmation. This overlap is called confluence, which we'll explore in detail in the next lessons. Make a decision. BABA has pulled back to the 61.8% Fibonacci retracement level after an upward move. Quiz: what action would you take based on this setup? Explanation: not quite. Traders often look to buy at the 61.8% level during a pullback in an uptrend, especially if signs of a bounce appear. But caution is key. It's safer to wait for confirmation, like a bullish candlestick or a reversal signal, possibly on a lower time frame. You've now mastered the basics of Fibonacci retracement, what the levels mean, where they come from, and how traders use them in real trading decisions. Next, we'll explore how another Fibonacci tool is used, not for finding pullbacks, but for projecting future price targets. Fibonacci retracement versus extension. In this lesson, you'll discover the difference between Fibonacci retracements and extensions. Some software may use projection. By the end of this lesson, you'll understand how to apply each tool to real setups and use both to build a complete trade plan. As you already know, traders use Fibonacci retracement levels to predict where the price might pause or reverse before continuing. There is also a tool called Fibonacci extension, which helps traders estimate how far the price might go after the trend resumes. While retracement levels focus on pullbacks within a trend, Fibonacci extension is used after the pullback ends to project how far the price might move in the direction of the trend. It helps traders set realistic profit targets based on previous price action. Fibonacci extensions help project how far a trend might continue after a pullback. By measuring the first move, traders estimate targets like 100%, 127.2%, or 161.8%, ratios that reflect how far price may go if momentum stays strong. To use Fibonacci extension in an uptrend, identify 3 key points. Point 1 is the swing low, point 2 is the swing high, and point 3 is the low of the pullback. These points help you project how far the next upward move might extend if the trend continues. In a downtrend, look for a swing from a high, point 1, to a low, point 2, and the end of the retracement, point 3. After a strong price movement and a retracement, traders often want to know how far the price might continue in the original direction. Fibonacci extension levels are one way to identify zones that the price may reach before losing momentum. In an uptrend, once the price finds support at point 3 and starts rising again, traders may enter a long trade. Fibonacci extensions like 100%, 127.2% and 161.8% serve as common take-profit targets, while a stop-loss is typically placed just below point 3 to manage risk. In a downtrend, traders use Fibonacci extension to project targets below the previous low, typically at 100%, shows price symmetry, 127.2% or 161.8%. They go short after the retracement ends at point 3 and place a stop loss just above that point. Fibonacci extension is a useful guide, but not always exact. That's why traders combine it with tools like support resistance, trend lines, moving averages, RSI, or MACD to identify stronger trade setups. Fibonacci levels aren't magic. They work like any other support or resistance zone. When price respects a fib level, it may bounce or stall. When price breaks through a FIB level, it can turn into a new resistance or support level depending on trend direction. Now that you know how Fibonacci extensions work and how to apply them in real trading situations, it's time to put your knowledge into action. Make a decision. Price has broken below the 127.2% Fibonacci extension level after continuing the downtrend. Momentum remains strong, and no clear reversal signs are visible. Quiz: what action would you consider in this situation? Explanation: not quite. While the move may be overextended, there's no sign of reversal yet. Shorting with trend continuation is often the higher probability play, especially after a clean break. Still, caution is key. Confirmation matters. Use Fibonacci extension. Price has broken above the 127.2% Fibonacci extension and is moving confidently toward the 161.8% level, supported by bullish candles and no clear signs of weakness. Quiz: how would you manage your position in this situation? Explanation: exactly. Once price clears 127.2% with momentum, traders often hold until the 161.8% level. It acts as a natural target, especially when there's no resistance or reversal signal. You've now learned how to use the Fibonacci retracement tool to spot pullbacks and Fibonacci extension tool to project price targets after a trend resumes. Next, we'll explore how to combine Fibonacci with indicators like RSI and moving averages to build even stronger, more confident trade setups. It's time to combine indicators. In this lesson, you'll learn how to enhance your trading decisions by combining Fibonacci retracement and extension levels with support and resistance levels, trend lines, and moving averages, MA. By the end, you'll understand how these tools work together to identify good entry points. Select the match. Do you remember? Let's match each indicator with what it helps you see in the market. Trend direction, Fibonacci levels, overbought or oversold momentum, moving averages, key price reaction zones, RSI, stock. You now remember what each indicator tells you. Now let's go a step further and see what happens when they all line up at the same price area. Confluence happens when two or more technical signals align at the same price zone, though three or more offers stronger validation. This overlap increases the level's significance and the chances of a strong market reaction, as multiple tools support the same price area. For example, Imagine price is pulling back in an uptrend and reaches the 61.8% Fibonacci retracement level. At that same price zone, the 50-period moving average is also providing support. This overlap of two price-based tools creates a confluence zone. Now, if the RSI is also coming out of oversold territory right as price hits this zone, that adds supporting evidence. It doesn't define the level itself, but it strengthens the case for a bounce. When price reaches a confluence zone, for example, a Fibonacci level that aligns with a moving average and confirmation from RSI, it signals a potential reaction area. Either price may reverse sharply or a breakout could see a spike in momentum. That reaction could be a bounce in an uptrend, where traders look to go long, a rejection from a high in a downtrend, where traders look to go short, or, if broken, the start of a strong momentum breakout in the direction of the trend. Confluence or not, price has pulled back to the 61.8% Fibonacci retracement and is also interacting with the 50-period moving average. RSI is rising steadily and currently reads 55.7. Quiz. Based on this setup, would you consider this a confluence zone? Explanation. Correct. The 61.8% Fib and the MA together form a strong confluence signal. What if there is no confluence? In such a case, it's usually best to stay cautious. Without multiple indicators aligning, the setup is considered weaker and carries more risk. Traders often wait for stronger confirmation before taking action. Confluence or not, price is rising from the 38.2% Fibonacci level, but the 50-period moving average remains far above, around the 78.6% minus 100% area. Quiz. Based on what you see, would you consider this a valid confluence? Explanation. Exactly. While the bounce from the 38.2% level shows a reaction, the MA is far above and no other tools confirm the zone. This is not a strong confluence setup. Now that you've seen how tools like Fibonacci levels, moving averages, and RSI can work together to highlight potential confluence zones, it's time to apply your skills. Remember, confluence can come from many combinations of tools. Your job is to find overlapping signals that strengthen the setup. What will you do? Price has approached the 61.8% Fibonacci retracement level, with the moving average just above acting as possible resistance. RSI is rising and now sits near 45, recovering from a previously oversold zone. Quiz. Would you consider this a valid confluence zone for a potential reversal? Explanation. Well done. The overlap of the 61.8% Fib level, nearby MA, and rising RSI shows confluence that could lead to a reversal, if price reacts at this zone. Now you know that when multiple tools point to the same zone, it increases the chance for a market reaction. You also saw why it's important to stay cautious when indicators don't align. Up next, let's test your understanding with a quick quiz. Price has retraced to the 61.8% Fibonacci level in an uptrend. RSI is stable, and a bounce is forming. What would many traders do? Wait. Avoid action without RSI and oversold. Sell. Assuming the price will break lower. Buy. Expecting the uptrend to resume from this key level. Short. Expecting a deep retracement. Amazing. You're planning a Fibonacci-based trade. What's the first step? Wait for a price pullback. Enter the trade. Identify the trend. Draw Fibonacci levels. Amazing. 2. You draw a Fibonacci extension after a retracement. Price breaks above the 127.2% level with strong momentum. What should you consider? Go short. The price is extended. Hold your long trade. Price may continue toward 161.8%. Stay out. This is unpredictable. Exit the trade immediately. Three. The price has broken below the 127.2% Fibonacci extension in a downtrend with strong momentum. What might a trader do? Hold. RSI is neutral. Go long. The price might bounce soon. Go short. The bearish move may continue. Close all trades. The trend is unclear. Four. Price pulls back to the 38.2% Fibonacci retracement level. RSI is near 50 and recovering. The 200 period MA is still above and sloping down. What's the best action? Wait. No strong confluence at this point. Sell. Price might fail at 38.2%. Buy. RSI is turning up. Enter long. Fibonacci level is enough. Price touches the 61.8% Fibonacci level. The 50 period MA is nearby, and RSI is at 57. What does this suggest? Confluence is weak. Not valid. A strong confluence zone for a potential long entry. Market is bearish. Avoid trading. No signal. RSI isn't oversold. What is the main purpose of Fibonacci extension levels? To project future price targets after a retracement. To set stop loss points only. To replace RSI and moving averages. To identify oversold conditions. 2. Price touches the 61.8% Fib level and also aligns with a moving average. RSI is near 56. What is this called? Pullback zone. Ignore other indicators. Confluence zone. Trend reversal. Extension failure. Three. Why do traders combine Fibonacci with tools like RSI or moving averages? To avoid drawing Fibonacci levels. To remove emotion from all trades. To only follow RSI signals. To identify price zones where multiple signals suggest greater significance. Four. If price reacts only to the Fibonacci level, but MA and RSI do not align, what should a trader do? Use Fibonacci alone without confirmation. Ignore the other indicators. Enter the trade confidently. Be cautious.